Good morning, everybody. Mike Tedeschi, investment strategist over at Perspective Wealth Planning. With this week's video, we're going to take a look at the major 4 U.S. indexes. We're going to take a look in at oil. We'll also take a look at the dollar and gold in today's video as well. So let's get right into it. Last week, we saw some very strong selling, and that culminated in the S&P 500 really finding a bottom back at March lows on this pullback right here. That is where we stopped selling, and subsequently we've had a very strong bounce here over the last couple of sessions. We take a look in at the NASDAQ. Right there at March lows is where it found support as well. When we take a look at the Dow Jones, it undercut the lows from March, but it also has been weaker. And again, if I put the 200-day moving average in on this chart, you can see it clearly was trading under the 200-day moving average for 4 or 5 sessions. It is back up over that, but it did undercut March lows, which would have been all the way back at 2,500. And if we take a look once again at the Russell 2000, undercut the lows, actually broke underneath that key 1500 level and is trading right back up around that zone. Even though we have seen a nice strong bounce here over the last couple of sessions, these are still not healthy charts. Let's break down the Russell. It's still under the 50, the 200, and the 20-day moving average at the moment. It's trading right around that key 1500 level, which we have talked numerous times about here over the last few months, and it has continued to still be the weakest index. Where might these things bounce? Well, if we're looking at the fib retrace levels, which is what I like to take a look at here for some bounce targets, I would be looking at the 50% retrace level on all the indexes. So on the Russell, that puts us at about 1540 as the next key resistance level. We take a look in here at the NASDAQ. We'd be looking right about that 7,400 level. If we take a look in at the Dow Jones on that 50% retrace level, we'd be looking right at about 25,700. And on the S&P 500, if we take a look at that 50% retrace level off of this sell-off, we'd be looking somewhere right around the 2840 zone. And so that's what we're going to pay attention to here over the next couple of sessions. All right, we've seen a lot of really strong V-shaped rallies out of this market in the past few years, so that's certainly something that we should pay attention to. Basically, as we're sitting right now on the technical side of things, we did break underneath the 200-day moving average, but we found support back in March and then made a strong, sharp bounce in the opposite direction. If this bounce can continue to sustain legs, the next real resistance level on these charts is going to be those highs from a month or so back. So this could very easily just have been our garden variety type of correction, move forward, get a little pullback, and continue on up. That would be the bull case here for us. The bear case, of course, is if we take out the lows that we put in on the 3rd. That is where we really can open up the opportunity for us to go back and kind of test that December, January low zone. So those are the two levels that we really should be paying attention to. Now, let's take a look in at oil. All right, we talked in depth about this in the last video. Looked like a potential bear flag sitting right there at that 38.2 retrace level. Subsequently, since then, it has continued to sell off sharply all the way back to the February lows, and that's that 61.8 fib retrace level from the move from last year up to the highs of this year. Now, RSI is at the 20 zone here, so I'm very oversold at this point in time. Seeing a bounce from those oversold conditions would not surprise me at all, but this chart is in a lot of trouble. Let me clear out all the fib retrace levels so you can take a look at this. Look at ultimately where we failed on our bounce attempt. We failed right back at previous support, broke underneath, came back up. And if we look at this on a longer time frame, what we still have is we now have a set of lower highs. The question, of course, is do we get a lower low? That's what we're looking for on a longer time frame. And this certainly could be, again, that channel broken, pull back underneath the 200-week moving average. There is a level of support that is right here. If we were to lose that, I do expect oil to go back towards those December lows. Now, the U.S. dollar we've talked about a number of times here in these videos as of late. Let's take a look in on a daily chart. The key level that we were really watching was this 98, just a little bit above 98, as it was really important going back multiple years on this chart. We subsequently rallied into that, and then over the last week or so, we have come off sharply from that, and we are still holding on to this ascending triangle, potential ascending triangle pattern at the moment. But really, any more weakness and a move underneath of 96 on the U.S. dollar would really open up the potential there for some more selling. And we saw some interest in gold here over the last couple of sessions. This can be looked at as a cup and handle. All right, we have the cup right here, and the handle, and then we've got that cup and handle breakout that has happened here over the last few sessions. Now, we have major resistance that goes back over the last couple of years, and I'm going to back this chart up and really look at this on a long time frame. All right, 1, 2, 3, 4 years. We go all the way back to middle of 2016. This resistance point is still important, and if I back this thing out onto a monthly chart, this thing is important at this level really all the way back into 2013. All right, this zone right here, this 1350 to 1380 zone on gold, we really haven't traded above it in 6-7 years at this point in time. And if we look at the longer term chart, this could be that ascending triangle pattern where you have a series of higher lows banging into that flat top. A breakout over that 1350 to 1380 zone on a monthly time frame really does open up the potential for a big move out of the gold space. And that is what we are very closely paying attention to. All right, it has failed the last 4 times it's come up into this zone. 1, 2, 3, and 4. So this is that 5th test here. Will we actually make the breakout, or will once again are we going to go back and fall down? A lot of that's going to have to do with what the U.S. dollar does from this point forward. So we're going to pay very close attention to that. Last but not least, let's take a look at the emerging markets. These lines are the lines that we've drawn on the emerging markets chart going back, the last 4 or 5 times we've taken a look in on it. The key, mid-inflection point level really is that 1020, and subsequently we did make a bounce up into that zone. One of the things I will say is the emerging markets started to move higher before the U.S. indexes bounced, and part of the reason for that could certainly be the weakness out of the U.S. dollar. Weaker dollar usually does well for the emerging markets. And so we're really going to pay attention to that 1020 level, which is now also the 200-day moving average. So you can clearly see we've traded essentially in 2 very similar size ranges. Right? If we take a look at this box right here and we just duplicate it and drag it up, right? The range is essentially the same size. All right, that's how we kind of get those measured moves. Typically, when you tend to trade in one type of range, when you leave it, you trade in a very similar size. And we're right back at the middle of this. So we're going to go back into the top box. If we get back up over that 1020 zone, your target would be up there towards that 1100. And if we fail right here, your target would be back towards these lows as well. I hope this video was helpful. If you guys have any questions, feel free to leave comments. Please like and share the video, and have yourselves a fantastic week. I'll see you guys next week. Take care.